Good morning, everybody, and welcome to the latest Urban Living webinar. Today, we are going to be looking at investment and lending in the living space. My name's George Sell. I'm editor of Urban Living News, and we are an online B2B platform for the hospitality and real estate sectors. Today's webinar is going to last an hour. We're going to have around 45 or 50 minutes of Q&A with our panelists, and then we'll save some time at the end of the session to answer your questions. So please do submit them using either the Q&A or the chat function in Zoom. Everyone who's registered for the session will receive a link to a recording in the next few days. So before we meet our panelists, just wanted to show a couple of slides. These are screen grabs from news stories we've run on Urban Living News over the past few months, just to give you an idea of the kind of investment and lending deals that are going on in the space. So if we go from left to right, the top left story, build to rent investment for Q1 this year was down quite a bit. There is quite a lot of up and down in the quarterly numbers, but it is very up and down at the moment. But we're also seeing some big players coming into the space. So Hines making their first move into UK build to rent. We've got some of the big institutional players consolidating their positions, LGIM buying student assets, PGIM building a big single family rental portfolio. And we're also starting to see assets being refinanced now. I know there's quite a bit of uncertainty over refinance, and there's a lot of debt which is maturing over the next 2 or 3 years in the sector, which is a conundrum that is going to have to be addressed. So if we move on from this slide, we can meet our stellar lineup of panelists today. I'm going to ask them all to introduce themselves briefly, and we'll do it as we see them left to right on the screen. So first of all, Sabine, good morning to you. I think you're on mute, Sabine.
Sorry for that. Here we go. Yeah, absolutely. Sorry. Good morning, George. Thanks for having me. My name is Sabine Schaffer. I'm a managing partner at ProInvest Group, a vertically integrated real estate investment management firm with a lot of expertise in the living sector, which combines for us in particular hospitality, extended stay, as well as now co-living.
Thank you, Sabine. Andrew, welcome to you.
Hi, everybody. I'm Andrew Saunderson, and I'm head of UK residential capital markets at CBRE. As you probably realised, that's not my corporate headshot. I think that's my current LinkedIn headshot, which I probably have to update. But thank you very much for asking me to join.
Thanks, Andrew. Celia, good morning to you.
Good morning, all, and thank you, George. I'm Celia Harrison. I'm Investment Director at Bridges Fund Management. Bridges Fund Management have been investing in real estate for 12 years now. We're currently fundraising for our 6th fund, and we've deployed £1 billion to date. A lot of what we focus on is in living across low cost and affordable housing, build to rent, PBSA, and more recently quite a push into co-living. But as a fund, we also focus on senior living, healthcare, and low carbon logistics. But my focus is very much anything that has a bed in it. So the healthcare and the living side.
Great, thanks, Celia. And finally, Jonathon, good morning to you.
Morning, George. Hi, everybody. Jonathon Ivory, Chief Investment Officer, Package Living. We are a living sector, or as we used to call it, build to rent, investor, developer, operator. We're at any one time developing 5,000–6,000 homes, and we operate across the multifamily, single family, and co-living sectors. And immediately following this webinar, I'm going to go and get a very cool I'm on holiday headshot, aka Andrew Saunderson LinkedIn page.
I think we all should now the sun's finally out.
Right.
Great stuff. Okay, so I'd like to kick off by talking about lender and investor sentiment to the various asset classes within living. I mean, we all know that the supply demand fundamentals are good, but the economic environment has been a bit rocky recently. There aren't as many deals being done as all of us would like, I'm sure, although activity is increasing. It's fairly slow. So I want to talk about specifically about the asset classes within living, and what's going on there and what we think is going to happen shortly. So let's first talk about build to rent, and we'll include single family rentals into that. Jonathon, let's kick off with you. How is lender and investor sentiment to build to rent, and what's deal activity like at the moment?
So I would suggest that sentiment remains strong. Deal flow and volume is down, and the reason for that is really simple. The underlying fundamentals haven't changed. It's just that interest rates have, and therefore the cost of financing has. So, and the output of the result of that is that the risk-free rate has moved out from near to nothing to over 5%. And I look at residential, and I think, actually, despite the inverted yield, so residential yields are arguably sub 5% for most asset or subsectors, and yet deals are still getting done. So in that context, I actually think it's proven remarkably resilient. And I think for a overseas investor, if you were a North American investor looking at that, you would be your mind would boggle as to the volume of transactions that are still happening, despite the fact you have an inverted yield spread. So I think that's a testament to the resilience of the sector, the underlying consumer demand for it, and the investor demand for it. My sense is that as rates start to fall, and it looks like that's going to happen less quickly than anticipated earlier in the year, but the projection of travel is still downward, you will see leverage become more accretive. You'll see more investors rejoin the market. There's lots of equity looking for lenders to sponsor them, and so I think that the forecast is bright, and I say it's just a testament to the resilience of the sector that there's actually been as much transaction volume as there has been in the last 18 months.
Towards the end of last year, a big chunk of investment into build to rent was specifically single family homes. It was 42%, something like that. Is that number going to be the norm now, do you think, Jonathon, or was that a one-off with a surge of activity?
I'm going to say that it is. I think there's a tipping point or an inflection point been breached. It was always the case that single family was perceived to be operationally inefficient, not the product for renters. So there are just sort of some misconceptions around it. Technology's helped a lot of that. I don't think we could have seen the growth of the sector, say, 15 years ago. So it's easier to operate schemes more remotely. But fundamentally, single family, the depth of the market is just greater. There are an almost infinite number of locations throughout the UK where it's entirely appropriate to develop, acquire, operate 1 to 200 units, whereas multifamily is more concentrated in markets that have the right Goldilocks fundamentals, so that the rents are at the appropriate level, the build costs aren't too high, land values are in the right relationship to the rest of it. The Manchesters, the Birminghams, the Leeds, the Bristols, and other towns and cities. But it's not as broad as it is the single family market. So I think for that reason, you'll see the depth of that market grow and grow and grow. So I think you've reached that tipping point or inflection point.
Yeah, thank you, Jonathon. Andrew, what's your impression of the build to rent market generally and single family specifically?
Yeah, I'm gonna agree with some of what Jonathon has said and disagree as well with some of what Jonathon has said. I agree with Jonathon's comments around the occupier demand for single family. I think the occupier demand is huge. I think where the challenge is going to come going forward is going to be where's the supply of the product going to come from. At the moment, the vast majority of the product is coming from house builders. And I have a fear that as soon as we see a recovery in the normal for sale market, the mainstream house builders will revert to type. The thing that we know about them is that they do not like selling at a discount. And they're having to do that at the minute because their normal market just isn't there. So if we were to see interest rates come down, and I'm not sitting here for a minute thinking that interest rates are going back to where they were 2 years ago, sub 1%, but we do see interest rates come down, and I think we can all agree that's going to happen. If we see a new government, which I think undoubtedly we're going to get, provide some support to the housing market, particularly to first-time buyers, I wouldn't be surprised to see the supply of homes going into the single-family market from house builders dry up a bit. Unless the market can get itself to a position whereby they can pay as small a discount as possible, and that probably is a sub 5% discount to still make it attractive to the house builders. If the market can't do that because the yields just aren't there, then I think the house builders will just deliver on demand in through the normal sales market, which they have done historically. So that's the only sort of cloud on the horizon for the single family market. And that is on the assumption that that is the route the house builders go down, and that nobody else steps into that. So the developers don't step into that market and start delivering, because they'd be much more comfortable delivering with a definite exit at the point they buy a site.
If that happens, Andrew, do you think some of the bigger institutional investors into build to rent will start delivering bespoke family rental homes themselves, or do you not have the economies of scale that the house builders do to make that viable?
I think that undoubtedly is a challenge. The challenge is around the build costs. The house builders, if there are any house builders on, I apologize for what I'm about to say because they might not like this, but house builders aren't real estate people. They're manufacturers. It just happens the widget they manufacture is housing, and for them it is about the raw material that they need, which is land. That is the key component that they need, and then it is about how efficiently can they acquire the materials that they need to build that widget, and how quickly can they do it. And that's where they have the upper hand compared to anybody else. The buying power of the likes of a Persimmon, a Barratt, a Vistry is enormous. If you're going in to speak to a brick manufacturer and you're going to order 2 million bricks, you have a lot more buying power than someone going in to order 50,000 bricks. And that maybe is where the challenge is. But, we do have a requirement to deliver more housing. It may well be that the house builders focus on the bigger sites, and that does then create the opportunity for the smaller developers to develop smaller sites of, say, 150 to 200 homes, which are perfect for single family rental. So that may be the way the market evolves over time.
George, can I just jump in on this house builder point?
Yes.
It's an important one. So I've got some insight into this because we've spent the last 2 years plugging away with house builders, doing deals to the tune of, I think, $500 million of capital is allocated currently to that sector. And I agree with Andrew to the extent that, well, I'm certainly not naive enough to think that as the market recovers, as the government administrations change, as interest rates fall, and inevitably there will be some other stimulus program for that community, because there just always is. Many of them will lose our number, and I'm relaxed about that, because there are enough house builders now who include the word partnerships in their name, and other kind of more SME, less PLC house builders for whom this model of being forward funded by institutions it's in their DNA now. So I'm not worried about the absence of house builders unwilling to sell at deep discounts, because frankly that isn't the business model anyway. If you're a through cycle investor, you don't need a 20% discount to get out of bed in the morning, and actually 5% or whatever it is frankly not the metric that instructs whether or not the deal is done. To Andrew's other point about them being manufacturers, investors won't be able and are unable to compete with house builders vis-a-vis just buying land competitively, and certainly can't build the product as efficiently. So I definitely don't see anyone getting into the house building business that way. But I do see investors like us extending the forward funding partnerships nature of the business model into what I would describe as just getting into the house building business. So partnering with house builders, buying land with house builders, planning land with house builders, and participating in the sales to owner occupier end of the business plan and offloading schemes to RPs, with the view and the quid pro quo being to carve out a parcel of build to rent within that scheme. I think that's a sensible, I think that's the true meaning of the word partnership. At the moment we have a kind of a phony war going on at the moment, with where you know, ultimately it's very transactional, very commercial. But I can see that being the evolution of the sector. But it ain't building houses and buying land, because no one does that better than those guys.
Yeah. I guess we're also seeing some house builders now being owned by either private equity or institutional investment houses, and perhaps there'll be a trickle down effect from that to the house builders to include a certain amount of rental housing on schemes above a certain size. You know, I think the mindset is changing. I think they are slightly more amenable to it now, but it's definitely an interesting space. Let's move on and talk about co-living for a bit, because this is an interesting one, and there are a lot of varying opinions out there. Celia, if I could come to you, we ran the story recently of your scheme with Hub at the Barbican, which looks a really interesting one. So you've obviously done a lot of build to rent. What persuaded you to move into co-living?
Yeah, we build to rent was where we I guess our natural progression from some of the build to sell that we've done with Hub and other parties historically. And we've done a bit of student as well. And we felt co-living was a bit of a natural progression from that, in terms of how these ways of living, particularly in urban areas, are evolving. We actually bought our first co-living site only about 5 years ago. So Yard House, which we successfully just brought CDL in to forward fund in January of this year, that was actually our first co-living scheme. And when we bought that site 5 years ago, we had co-living as an option alongside student. And we decided to pursue a co-living planning route there. And it took some time working to get that through. But we have actually, I guess, therefore been in the co-living market for quite some time, but haven't necessarily seen the depth of opportunities come into the market. We've continued to invest in build to rent, we've continued to invest in PBSA, and co-living's been on our agenda, but we've not necessarily seen the amount of opportunities coming forward until the last 18 months or so. So yeah, last year we acquired 2 offices in the city, very much with the intention of retaining as much of those buildings as possible and bringing them back from being relatively redundant offices, slightly out of pitch, low ceiling heights, low spec, poor environmental standards, to convert into co-living space, to really kind of work through the embodied carbon position, but also bring a bit of vitality back. And it's something which the city are so far supportive of, albeit in the right areas. But for us, we just feel it's a really, it's obviously an emerging part of the market. The schemes that have come forward in London recently are really starting to show some of this secondary and third generation stock, and the type of co-living that they provide is quite different to some of the other forms of co-living that have emerged in the last sort of 5 or 10 years within London. We see it as an opportunity to provide sort of a second generation product, often at a discount to that you could get for a studio or 1-bed apartment in the local vicinity. And in some instances also as an alternative to people who would otherwise live in HMOs, slightly poorly governed. So having been a sort of professional landlord or professional operator, providing just more choice into the market for either individuals, singles who want that private space, but the benefit of the community, new people into a market, expats or people who've come for work who want that flexibility of lease length and tenure, but also want the opportunity to meet new people, and also often want to be in sort of some of the cool parts of a city and some of those central locations. We definitely don't see it as the solution to housing crisis by any means. We still want to continue to invest in some of the build to rent. We've not done anything in the multi-family sector, but is, I think, an opportunity we feel we've missed perhaps. But continue to invest in other forms of housing, but we do feel co-living is part of that solution, and particularly the ability to be able to work with existing buildings, typically offices, and convert those where the floor plan suit is really just a sort of nice double solution, in part to the housing crisis and in part to help in terms of the climate crisis as well. So yeah, we've got two, I guess, assets in the portfolio in planning, and then obviously the one out at Wood Lane, and that's now on site, forward funded to CDL, and a sector we want to continue to do more in if we can find the right opportunities, ideally sort of urban locations, and ideally on the sort of existing building conversion route.
Mm-hmm. And when you say second generation co-living product, I presume you mean bigger units than version 1. So we're talking about 18 to 20 square meters per unit.
Yeah, so we're actually going a little bit larger than that. So Wood Lane, Yard House, as I should call it, is all 23 square meters there. And then obviously some larger DDA compliant units. Our submission in Barbican at Beat Street is from about 20 to 23 square meters. And then we're looking similar on the other schemes to bring forward. So actually a bit larger than some of the 18 square meters, and obviously a little bit above some of the recent GLA guidance. We feel there's an opportunity to really, as we've started to see in some of these sort of new products coming forward, improve the length of stay in co-living and improve that tenure. And we have a hypothesis, and we can only call it that because it's not yet to be tested in the market, that we, given that bit more space, gives the opportunity for people to stay a little bit longer if their lifestyle changes. If they've got a little bit more income, or they meet a partner and there's actually space for 2 of them to be there, or suddenly their job changes and they want to work from home a bit more and can't work in co-working space because they need the ability to take private calls and want to be able to do that from their home. Just actually having that little bit more space may improve length of stay and tenure, but also just improve that kind of quality of life and well-being as well. But we've seen great spaces at 18 square meters as well. There's some of the stuff that DCZ and Folk have done. They're really kind of high quality spaces. We are going a little bit higher, but also with that focus on actually providing good quality space is almost as important as actually how big that space is, and in some cases more important. So yeah, trending upwards, and then of course with the amenity provision that sits alongside that as well. And really trying to make sure, particularly where we're doing office conversion, that we aren't bringing about some of the negative perceptions that have come from permitted development. Because we do still hear that. We hear that a lot from our investors. We hear that a lot from the market. But office conversion just means permitted development. It means poor quality space. So the further we can move ourselves away from that, and some of the stigma that's come about from that in some markets, we feel we're putting ourselves in a better place from an institutional exit perspective as well.
Yeah, thanks, Celia. Sabine, you're doing something quite similar, but on the other side of the world. You're converting offices and also hotels, I think, to co-living. What was the rationale behind getting into that?
Yeah, sure, absolutely. I think it's quite interesting, because I think just the approach we're taking does certainly come more from the hospitality side. Because if you think about, hotel, if you think about long stay, and if you think about an extended stay, and if you think about co-living, you see an awful lot of similarities. And you're rightly in saying that we are currently doing this with our Australian platform, but we're also already out for the hunt for some assets for conversion with our UK team as well. So I think the rationale here is, as I mentioned, it's a logical extension of hospitality. If you think about or at least the feedback that we receive from people who sometimes decide to stay with us for, a month, 2 or 3 months in our existing hotels, it's quite interesting because, one is obviously pricing. Sometimes, if you're staying in a hotel room, clearly it can be cheaper as well than if you start to stay in a serviced apartment that's 1 or 2 bedrooms, and obviously larger. So net effectively, it's better from a budget perspective. But also there is I call it a kind of a social aspect as well, right? People do enjoy having breakfast downstairs with somebody, talk to people, or have a glass of wine with people in the evening, or beer, or whatever it may be. And I think that some of the existing kind of residential facilities that have been built are good in many areas, but not necessarily providing that kind of communal space that basically from a hotel's perspective, that's what we are, that's our DNA, right? That's what we've been doing all the time. Knowing how to activate spaces is something that's very inert in hospitality industry. And I think we probably have one or two kind of ideas how to bring that knowledge into the kind of co-living, or let's say kind of living environment more in general. Other than that, yeah, I mean, I'm absolutely agree with Celia about, I think the attractiveness of co-living as an asset class, simply because compared to some of the other, for example, student housing kind of areas, which obviously are very good investments as well, but you tend to be able to target a wider audience with co-living. So in other words, what we saw is that, if you have co-living opportunities happen to be closer by to universities, there is a disproportionate amount, I guess, of tenants that is going to be students. Because I think ultimately, and I may be wrong, but, when I was a student, for me, it was all about the convenience and proximity to university and price. These are the two most important factors, because the more I could save from a rental side, the more I had to spend on other areas, right? Having a fixed budget per month. So, and then it is true as well, that depends obviously on what you're following, but, in some instances, co-living actually can provide, as Celia pointed out, maybe some larger spaces, or maybe just spaces that are a bit more, I guess, designed in a more innovative way. I mean, I just want to point out to people that, in the hotel industry, we went through the same evolution whereby, about 20 years ago, if you talked about a 5-star hotel room, you're always thinking about 35 square meter plus, right? Nowadays, I can tell you that you do have 18 square meter 5-star hotels. So it just depends on how you're doing the design, you kind of, what's your floor to ceiling height? And there's many, many areas of how to make even an, 18 square meter or 20 square meter room look significantly larger than it is. So I think these are the kind of things that we quite like about co-living. Maybe the last point to mention is that although we did and we are doing a lot of ground up developments of assets, we just believe that currently, and I mean, this is something that, Jonathon obviously pointed out, given the interest rate environment, there is a bit of a reluctancy, let's say, from some of the usual investors, and they prefer to probably more focus on maybe refurbishment and conversion of assets rather than necessarily ground up development. And that's obviously something as well that we've been doing for, the best part of 20 years, focusing on old hotels, converting into new hotels, focusing on offices, converting into hotels. So I think it's that very expertise as well, that I guess, at least among Jonathon and Celia, I'm sure is also there. But having that skill set in-house, having done it before, and then also having the operator in-house as well, who before the actual refurbishment conversion happens, is going to make the developer aware about, think about the operating efficiencies, think about distances, think about, those things. I think that's an advantage that we have, which I think ultimately, hopefully, allows us to, come up with a product that's going to be not just, more favorable for tenants because of the amenities, but also and the kind of the social aspect, let's say the community areas, but also from an operating perspective, as efficient as possible.
Sabine, have you got any comparisons as to the revenue per square meter generated from a co-living product with a service?
That's always, I know that's always a question we're being asked, and obviously it depends, it's a case by case, but all I can tell you is that it is intrinsically easier to operate co-living than it is to operate a hotel. And as a result, you can imagine that the actual cost associated with the operation of co-living are obviously lower than the cost of operating a hotel. So, but from an NOI perspective, it just depends. It's not as easy as saying there's no case by case. What is nicer about the co-living, I guess, asset class is obviously being kind of closer to the more traditional living kind of BTR, although obviously it's not, providing such a long-term lease, but still, obviously the cap rate that valuers are going to be using on your asset are significantly lower, or in other words, more compressed than, what you normally are used to see in the hospitality space. So there is that, I guess, upside that can be created, by if you're, able to convert an asset from hotels into co-living, there's clearly a bit of an upside that can be created there, which obviously we are leveraging off as well.
Yeah, thanks, Sabine. We've got a question in here. Celia, I'm going to aim this one at you. What is the appetite on the lending side for co-living assets which sit outside sui generis use class? Where is the market pricing and what metrics are key for lenders?
I would say probably not the best place to answer that one, because we've not got debt on any of our schemes yet. We'll be looking to take them to the market for the kind of construction piece. when we get to the post-planning stage. But yeah, we don't have any, wouldn't say I've got too many insights on that in terms of this sui generis versus sort of C1 or quasi C1 consent. Unfortunately, because it's just not a market we've touched, with CDL obviously coming in forward funds. We've not needed debt on our asset out at Yard House, and as I say, we're hopefully in the not too distant future we'll be looking to go to the market on the next two pieces. From our perspective as an investor, on the equity side, we are looking to do all of our co-living consents under sui generis use class. We've looked at C1 and we can see the benefits definitely in some local authorities and in some markets. But most of what we're looking to deliver, and obviously everything we're on track to deliver at the moment, will be under sui generis use class. We feel some of the restrictions that sit on the C1, as Sabine touched on, can add to that sort of operational cost side of things. But we are finding you have very much in London in particular, but across the UK, a borough by borough, local authority approach in terms of whether they're comfortable with C1 having that sort of longer length of stay, or whether they'll put some kind of quite onerous conditions on operating under a C1 consent. Anything from the amount of cleaning that needs to take place, need an on-site restaurant provision if you want to be under C1, obviously the length of stay, and restrictions on length of stay, which can, if you're trying to produce an asset which enables longer length of stay and building up that community for tenants and for residents, can be a little bit restrictive and onerous on your operations and ultimately lead to more costs. So yeah, we're very much sticking in the sort of sui generis use class for the assets that we're bringing forward. But how lenders view it, not an area of my expertise, certainly.
Yeah, Jonathon, did you want to chip in on that one? I think you're on mute, Jonathon.
Apologies. Yeah, I'm happy to have a stab at that because we've dipped our toe into the murky world of non-sui generis or C1 co-living financing. Without giving up sort of, reeling off term sheets, that it won't be surprising to learn that the pricing is more expensive than it is for residential, and I include co-living in that. And the reason being is the bank ideally wants the product to look like multifamily. It wants longer leases, not shorter leases. It wants lower churn, not higher churn. It wants higher retention, not lower retention. And so the closer you can get the product to that which looks like multifamily, albeit under a sui generis consent, will elicit the most favorable financing terms. The more it looks like a hotel, to use that expression, if it looks like a duck, it quacks like a duck. That's how it's going to be priced, and more importantly, valued. So we kicked the C1 ball around a lot because we liked the idea of the flexibility, the premium that you get from the kind of the rent. But fundamentally, I think the challenges are, it feels like the worst of both worlds. You don't quite get the premium of the hotel, and yet you're saddled with hotel overheads because of the churn and the intensity of the management. You are valued like a hotel, so you don't get the residential valuation. The pricing on the debt, which we've discussed, isn't as favorable. And so you're just kind of squeezed from both sides. And fundamentally, I'm not sure that the planners are going to be that enamored with that at a kind of a universal, every borough, we operate in London, level, because it feels like co-living through the back door. And the benefit of doing it is there's some tax, VAT savings if you go down the C1 route, and also you don't have to deal with affordable housing. That's why everyone has a look at it. But I think the conclusion, or the reason why most of the sector, and I want to say 80+% of the consents are sui generis, is because I think everyone's concluded the same. It may work on an individual basis, but it's not a scalable business model, or at least that was our conclusion. So long-winded way of saying, yeah, the debt's more expensive, but also there are other factors that are working against the aggregation of that business model at scale.
Yeah, thanks, Jonathon. Andrew, did you want to chip in anything on co-living before we move on to talk about student?
Yeah, I don't think there's too much more that I can add to that.
Only that you'd like to live in one.
Sorry.
Only that you'd like to live in one.
Obviously, and primarily one that you've developed, Jonathon. Undoubtedly, across the living space, there is debt available for be it investment or development. But the cost of that debt just varies from asset type to asset type, location to location. And I think as it stands at the minute, co-living is probably the newest of the living sectors to emerge. And the cost of that debt is reflective of that. Coming to Jonathon's point, yes, banks ideally want it to look as much like build to rent as possible because that's the market that they do understand. They also understand the PBSA market, so it probably sits somewhere in between. But what they're also very focused on is what are the operational costs. They're very focused on, what's the debt service cover ratio going to be, what's the income cover ratio going to be, et cetera, and all of that will go into the mix when they determine what the appropriate margin is. So I think it is very much case by case.
Thanks, Andrew. Sticking with you, let's move on and talk about PBSA.
Yeah.
Obviously a much more established market. We're seeing quite a bit of M&A now, acquisition of real estate platforms and operating platforms, but still a huge undersupply. We're hearing all these stories of students having to live in one city and study in another.
Yep.
Universities paying students thousands of pounds to defer their courses for a year. In such a mature sector, which has ridden several ups and downs and bumps before, why are we still looking at such a imbalance of supply and demand?
Very simply, it comes down to one word, and that's planning. Our planning system that we have is just not fit for purpose, bluntly. Local authorities understand the need to provide more homes, be that build to rent homes, be that PBSA homes, be that co-living homes. But actually getting something through the planning system is just so challenging. And it doesn't matter whether you're operating in London, Bristol, Leeds or Manchester. There are differences between each of them. But the feedback that we get almost across the board is it is just very, very challenging. In PBSA specifically, one of the particular challenges that I think developers encounter is twofold. One, students don't pay council tax. So it creates issues from a local authority's perspective when it comes to budgeting, that they know if they grant a scheme, they're not going to get the benefit of any income from a council tax perspective. And also, students don't vote. So from their perspective, that's not overly helpful, is it? And it is something that is going to create issues. We do have an unbelievably good universities sector, but it is very, very dependent on those people going to universities being able to access housing to meet their needs and not having to pay a fortune for it. And that for me is the issue that the sector, and it transcends all living sectors, has to deal with, is how can we make the planning system more efficient to deliver more homes? Because that is the easiest way to battle the affordability issue that we have. It's very, very simple supply-demand economics.
Celia, with traditional buy-to-let landlords, operators of HMOs who have traditionally provided accommodation for a big chunk of the student market, leaving in large numbers. Is the PBSA sector going to become more attractive to investors? Is this something that you're looking at doing more of?
Yeah, we've been looking at PBSA increasingly so for some time. We've got a scheme in Belfast we're about to PC, which we believe is going to be very well received in the market. They're about to really start on some of the let-up ahead of September opening. We've got a scheme we're about to start on in Edinburgh as well. And I think to echo Andrew's point, it's a market where there's been a little bit of a movement away from some of the institutional capital sort of post-Brexit, a little bit uncertain what the future of international students coming into the UK might be, if they're going to be increasing restrictions on that. And we've actually not seen that. I think in the UK, the international student numbers have increased 44% in the last 7 years. We've actually seen a kind of continued growth in both the domestic and the international market. So there was a time where I think a bit of institutional investment moved away from the sector. And I think we're probably at the point now where that is really trying to return. And obviously we have seen quite a number of transactions recently on the PBSA side, particularly on sort of the stabilised stock piece. But it's continued to be constrained by that planning piece, as Andrew alluded to. Again, in Edinburgh, they've just changed their local plan, so you can no longer provide purely students on lots over a certain size. So the scheme we've got there is 632 units. You wouldn't get the size of that scheme today. We'd have to provide, I think it's 35% on-site traditional residential alongside that. And I think it's on anything over 100 student homes, you have to now have that mix. So they're restraining it, and Edinburgh's already been a very constrained market in terms of their student supply. We're seeing similar movements obviously in Glasgow with restrictions in terms of areas. We're seeing restrictions in Bristol starting to come forward. Also the introduction of affordable in more places, which I do think has a long-term benefit to the student population in some of these cities, particularly in these markets that are really constrained. But that doesn't necessarily overnight give a more of an exciting opportunity to investors, particularly where some of these changes come through quite last minute, or where policies change quite quickly, because it does just shock people and may delay more stock coming forward until they can work out how to make sure their product that was once viable is still viable with the affordable in there as well. So no, definitely a sector we want to get into because of that kind of supply constraint. We come in typically as an investors at that planning stage, working with people like Package Living through the planning journey, but it's difficult. And the political environment, particularly around PBSA, as Andrew alluded to, is difficult, and we see it becoming increasingly difficult. But that only gives rise to more of an opportunity if you can get your hands on good sites, good stock in good locations. And we're not really seeing much of a divergence across the UK in terms of the sort of the supply coming through. A lot of the markets continue to be much more constrained in terms of the purpose-built stock relative to the number of students than they were 3, 4, 5 years ago. It's not moving in a good direction in the majority. We're seeing a similar trend across the UK. So for us, looking at those kind of key regional centres, but also some of the less red brick universities, as I say, looking into Belfast and those markets, we do feel there's quite a lot of opportunity if we can get our hands on the right stock, the right locations, and be comfortable that we can get through the planning and the political journey that will likely come with that.
We spoke earlier, Celia, about co-living version 1 and version 2. In PBSA, we're probably on to version 7 or 8 now. And some of the stock I've seen is really impressive, and it's not that different from build to rent and high-end co-living. So are the development costs of PBSA different from those other asset classes? Is it still slightly cheaper to develop, or are they more or less in the same ballpark now?
Yeah, we're still finding it slightly cheaper in terms of, I guess, on a kind of per unit basis, definitely. It is becoming more amenitized, as you said. The student blocks that I was familiar with and those before me that we've been familiar with are very different to those that are being brought forward today in terms of the on-site amenity, the libraries, the sort of study space that you have in your blocks, the cinema rooms, the lounges, the gyms, etc. It's very different to what was effectively a shared kitchen and a small foyer, if you were lucky with maybe a vending machine. So it's definitely a different product, but I think we're not finding build costs there any more prohibitive than we are in the other residential sectors. I think build costs as a whole are challenging across build to rent, across co-living, across the sort of PBSA side and on the senior side as well. But it's definitely a more amenitized product. Again, that sort of increase in international students has also had an impact on some of the types of offering. A lot of the cities are increasingly sort of undersupplied in terms of studio space, less and less interest in clusters. We're seeing much higher rental growth in studios, often being driven in part by sort of that international student and the interest to have that private space. And again, sometimes the spec that comes with that. But yeah, from a cost perspective, we're not seeing it any more prohibitive than the issues, very similar to what we're seeing in build to rent, as that also evolves in terms of the amenity often and as co-living does in the same right.
Yeah.
Just
Thanks.
on that, George, if I can just add one more thought here, because I do very much kind of chime in what I guess Celia is saying towards the end as well, which means, you know, if you think about where student housing used to be 20 years ago or 25 years ago, right, which was probably a niche asset class, and, you know, everybody saw the opportunity, but it was a bit like a quite fragmented market at the end of the day, with some smaller players, you know, maybe having one or two projects. And then I think over the last 10 years, you really saw this market kind of coming together. You know, you had more institutional money kind of being made available. You know, you had more dominant players as well. And I guess because it makes sense, right? And I think something similar is probably bound to happen as well on the co-living side. I think that you know, if you fast forward, if you think about the fact that there is 1.5 million people moving into an urban area every week in this world, I think the simple demand for some smaller housing units within an urban environment are just growing literally by the day, right? So and we just we do not have a space, nor can we afford for everybody to have 2 or 3 bedrooms. So that trend is something that I have a hard kind of time seeing to turn back anytime soon. And the funny thing is, if you actually take out the classical focus of co-living, which probably is the young 20 to young 30-year-olds, which is kind of, you know, including maybe the student, the person who starts work first, up until, let's say, the young couple, there's also an argument to be made about, you know, if you look up the age scale towards the 50-55-year-old, to the empty nesters who all of a sudden no longer have the kids at home, who probably would like to have some flexibility, you know, who would like to start traveling around, and to whom potentially, you know, I'm not saying for everybody, but, you know, something like a co-living unit over a period of time may suit also quite well. So I'm just trying to, you know, for everybody here, you know, in the audience as well, you know, I think that I do believe that co-living is just kind of in a nascent area, but certainly where student housing maybe might have been, you know, 10, 15 years ago, and look where student housing is today.
Mm-hmm. I was at MIFIM a couple of years ago, and the CEO of Habit, the living operator, said that the most attractive thing about their offer for the consumers was convenience. It was the speed you could move in. It was the speed of the reference taking, the financial transactions, and he said their age group went up to mid-70s. And yeah, and a lot of, you know, also couples splitting up. Sadly, a lot of this demand came from people who needed to find somewhere to live quickly. Yep. Relationship breakup. There's all types of different customer demographics.
Yeah.
Let's move on quickly and talk about later living. Andrew, this is an interesting market because the supply demand fundamentals here are off the chart. You know, the demographics look so good, yet the delivery is so slow. It's obviously a more complex product. It's a more complex sale. But when you look at the penetration rates here compared with Australia, New Zealand, for example, you know, they're just in another league. Why is it? Does this come down to planning again? Is this the root of the issue?
The honest answer is I don't know. It is an area that we are giving increasing thoughts to. As you say, you know, the scale of the opportunity is huge, and it's just going to get bigger and bigger. You know, fundamentally, everyone is getting older and older, and at some point, you know, we do have to start looking at the under-occupation of houses. You know, that is a significant issue in the UK housing market, but I just don't think anyone in government or shadow government, for that matter, is brave enough to say it. I often cite the example of where I live in Chiswick in West London. You know, we're surrounded by people living in family homes, and there's just 2 people living there because the children have gone. You know, that is causing a significant block in the market because there's nowhere else for them to go. If someone can deliver a later living product at scale, be that for rent or be that to buy, that really does work and meets people's needs, I think you would then start, and it's not a, you know, it's not the answer, but it would start to relieve some of this pressure that we have, which is in part, as I say, caused by under occupation. I think, you know, there are some brilliant operators out there. The likes of Birchgrove, I think what they've done is absolutely fantastic, and the product that they're delivering is brilliant. But when you talk to them and you talk to them about the lease up rate and how slow it is to get to stabilization, that is what causes part of the issue and causes part of the problem for investors to come in. It's just too slow. It is such a journey that you have to take these people on to convince them to sell what was the family home and move into this rented home. And no, we're not going to be able to kick you out after 6 months. That's not how the business model works. It's an education piece. And if we can start educating people and start really getting people to understand that the benefits of what this can offer, I think it is a sector that undoubtedly will explode. But what it really will need is in the same way, and Jonathon and what the packaged living guys have done has been incredible with Aviva, is it needs that very cheapest cost of capital in the market to come in from the likes of Aviva, the likes of L&G, to really put some finance and money into it to help grow it quickly. So I do think we're moving in that direction, but I do think it is going to take time before we have a sector. But I am excited about it. It is, as I say, an area that we at CBRE are beginning to very seriously look at. We only have to speak to our colleagues in the US who tell us about the scale of the market there, the scale of the opportunity. It's going to come here. We just need to get the model right. And I just don't know what that model is right now.
George, can I chime in again?
Of course, yeah.
Okay. As annoying as it is, I find myself agreeing with Andrew 100%. My two observations would be that I think the rental model, as opposed to the event fee, the sale model, is the model. To Andrew's point, it needs institutional capital, which is a proxy for the word cheap or efficient money, to unlock the sector at scale. And institutional capital, by its very nature of the underlying policyholders, often they are focused on income and capital growth. So it's rental, not sale, not a trading business. Putting aside the operational challenges and the educational challenges and things like that, I think the bigger challenge, societal challenge, if you will, that's being stored up is how the consumer, the renter, is going to pay for not necessarily the rent of that home, but the care as and when they need it. Because right now, because of the success of the build-to-rent sector, you have generations of people moving through the gears of PBSA, co-living, multifamily, single-family housing, now ultimately into retirement rental housing, all owned, all institutionally owned, and those consumers are not accruing any wealth or any equity in housing if they're just perpetual renters. So how they're going to pay for the care that's required once they move out of the kind of low touch retirement housing, I think is an issue that the government, the country, we as a people kind of need to address. Because it needs to be funded from somewhere.
Celia's got a hand up. Maybe.
No, I have. Yeah. I also obviously want to chime in, and given that Andrew gave such high praise to Birchgrove, I want to agree with everything that Andrew said in the same merit as well. And I guess just for a bit of context for those listening who aren't aware, so Bridges, we set Birchgrove up 8 years ago, I think probably now. We've got 9 sites, assisted living for rent, the first entirely rental model in the market. And that's all we want to continue to do. I completely agree with the point from the 3 bedrooms piece, Andrew. We are now at the stage where we've got 3 operational sites, and we'll come on to the institutional money because M&G bought 2 of those, which Birchgrove still operate. But we've now got 3 operational sites. So we've had about, I think, 190 residents at this point, sort of through the doors. So we're starting to get some good data, and we're also starting to be able to build data on how to reduce that lead time to get them moved in quicker, because that is key, particularly for us as a fund where we aren't long-term investors. We have a limited life on our closed-end funds, where we've got competition for capital across build-to-rent, co-living, and we invest in senior and in Birchgrove alongside that. The business models on Birchgrove are just really long because that fill up compared to build-to-rent, compared to co-living, it is so much longer. But we now increasingly have obviously a team that are much more skilled. We've got data, we're understanding, and we've got a lot of learnings from the US to bring in as well, how to really sort of condense that lead time, and in doing so, increase the fill up. But the other bit on the unlocking bedrooms, given we've now got sort of 180 data points, we can start to actually take that data to planning, to local authorities, to say, this is what we can do to homes in your area by developing sort of 50 or 60 apartments here and allowing people to right size into 1 or in some cases 2-bedroom apartments. This actually frees up, you know, in Ewell, it freed up X number of family homes and brought those back into the market, 5-bedroom homes or 4-bedroom homes. And actually the number of bedrooms that were sort of given back to the market. And we're starting to be able to build that data, which is great. So now I think there's huge opportunity in the sector. We want to continue to roll out Birchgrove as a rental model. So great, Jonathon, as well, that you think the future is in rental, because we certainly agree. And Andrew, we just good to hear that you're in Chiswick in reference in all of those homes, because we've just got planning consent there to bring Birchgrove through on the high street. So hopefully we'll be.
I've seen that. I've got my eye on it. Actually. Yeah, it's the old police station. I think that's unfortunately, you may well have filled it up before I'm ready to move in, but I think it's a great spot.
So yeah. But no, yeah, so it's a huge market. It's growing, and it's growing much quicker than the pace of supply is keeping up. So yeah, we do just want to continue to invest in that, and as I say, particularly for us on the rental side.
George, it's a question as well from a cultural side, right? Because if you think about other markets, such as the German market or the Austrian market, indeed, I'm Austrian by background. I mean, the vast majority of people are used to rent, right? And actually, it is true that, you know, some things need to be taken into consideration. In particular, I guess the letter of the law is more sitting with the person who rents than necessarily the landlord. So there is actually the ability that the kids have the right, the children have the right to continue renting. I mean, there's all kind of things, you know, that obviously may not be as seen as favorable, but at the end of the day, you know, there are many examples whereby, you know, people are used to rent for the majority of their lives, and actually, you know, it doesn't seem to be, you know, causing too much of a strain. I appreciate what Jonathon said about the elderly care, and somebody has to take care of it. But again, this is going then to be also up to the government to ensure that the necessary fundings are being put in place. So, but yeah, if you look at the obviously home ownership in places like Germany or Austria, significantly lower than in any Anglo-Saxon country.
Yeah. There's a new company called Looplive who've got quite an interesting model, and they will have rental retirement apartments, but they will also take on the family home and rent that and generate an income from that, which goes towards the rental of the retirement unit. So it circumvents the need to sell the family home, which I think is one of the biggest stumbling blocks for moving people into retirement accommodation.
Although we are now in a sweet spot, but it may not last too long, that if people are selling that home and putting the cash into the bank, into savings, the interest you can generate on that can also go at the moment quite some way to funding and contributing towards your rent. But we know that's not, hopefully, that's where it's going to last for the medium term. But no, yeah, definitely agree with that point, George. There's a huge opportunity for these alternative models to come in to help people get out of the homes and have that be able to keep that attachment or that value or the inheritance or whatever it may be, but also move to something that is more of the right size for them and their needs.
We didn't get around to talking about interest rates in detail, or indeed a lot of the stuff on our agenda, because the hour's absolutely flown by. So thanks for all your contributions. Really interesting session. Just going to show a couple more slides before we wrap up, and we'll leave the session open for a minute or two at the end, so you can copy and paste some notes from all the good stuff that's been in the chat. So our next Urban Living webinar is on June the 14th, and it is all about mixed use development, which is obviously incorporates a lot of these living sector asset classes that we've been talking about. The link to register for that session is in the chat. If you'd like to work with us at IHM, either on our online offer or our in-person events, get in touch with my colleague Henry, whose details you can see there on the screen and also in the chat. And finally, thanks for joining us today. Thanks to Andrew, to Celia, to Jonathon and Sabine for their fantastic insights. Thanks to you all for watching. If you're on any of the social channels you can see on the screen there, give us a follow and interact on there. You can see the LinkedIn profiles for all our speakers in the chat. So if you'd like to carry on the conversation with them after the session, then by all means do. Enjoy the rest of your day and have a good weekend, everybody. Thanks very much. Bye-bye.
Bye-bye. Thank you.
Hello, we are International Hospitality Media, or IHM for short. IHM is the #1 brand to engage with decision makers in hospitality and real estate. Our 4 multimedia brands lead their respective sectors with breaking news, comments, trends, and opinion across a variety of multimedia solutions. We provide an inspirational community to connect people through world-class events, webinars, podcasts, award schemes, and much more. But let us share our story of who we are and what we do. Over 10 years ago, Piers & George had a light bulb moment to provide expert opinion, comments, and low-cost digital content. And so they went on a journey over the past decade, creating media platforms to serve the hospitality and real estate industries. We now have an engaged audience with a reach of over 60,000 monthly visitors across our website, 48,000 of our email database across all the sectors, and over 67,000 across our social channels. Everything we do believe in challenging the status quo. We believe in thinking differently. We make things simple and very easy to work with us. And we're a friendly bunch too. We offer creative solutions to help you achieve your business goals. Read, watch, listen, meet with IHM. Contact us for a chat today. Just look at some of the brands we have worked with recently.